Hello, I'm Bernard Hickey with the daily briefing from interest.co.nz. Today we'll look at ANZ National's latest results and some early signs that higher interest rates and a squeeze on disposable income is forcing some borrowers to default on their loan payments. We'll also look at what's happening with mortgagee sales. There's quite a few going on at the moment and we've started an informal way of monitoring them. And we'll quickly look at the New Zealand dollar, which has jumped to a post-float high on strong investor demand for our amazingly high interest rates. But firstly, news that ANZ National has reported strong profit growth and is growing its market share in mortgages and term deposits. But it's also starting to see what it calls a modest increase in borrowers who haven't paid their bills for more than 90 days. ANZ National's tally of loans that haven't been paid for more than 90 days rose 50% in the December quarter to $154 million. ANZ National's CEO Graham Hodges told interest.co.nz there has been a pickup in the number of people still in arrears, but he says many self-cure their situations within 120 days. So we'll wait another 3 months or so before worrying too much about it. But it's clear higher interest rates and squeezed disposable income is having an effect. Hodges also says ANZ National is being marginally more cautious about lending to people who can't document their incomes and assets and to those with very high loan-to-value ratios. He also reckons it's dangerous right now to lend 100% to anyone who can't afford the payments, because any home buyer would be sitting on negative equity within a year or two given house prices are falling. ANZ National is not alone in seeing some stress in the market. BNZ's past due assets more than doubled to $81 million in the last year. But you've got to remember that ANZ National's and BNZ's past due assets equal just 0.14% of their total assets. There's a long way to go before it's a real problem for the banks, but it's worth watching nonetheless. Speaking of stress in the housing markets, we've decided to keep an eye on mortgagee sales. We're checking the property websites regularly for mortgagee sales and have created an index that combines the number of sales listed on TradeMe and realestate.co.nz. Currently, there are around 105 properties subject to mortgagee sales in New Zealand right now. That's been reasonably steady over the last 3 weeks. It's too early yet to discern any trends, but we'll keep an eye on it, particularly now that house prices are falling, and it will make sense for some buyers in negative equity situations to simply hand the keys back to the bank. That's what people in England did in the early 1990s, and that's what people are doing in the United States right now. Finally, we take a quick look at the New Zealand dollar. It surged to a new post-float high of 81.3 US cents on Tuesday morning. This is all about interest rate differentials. Currently, our official cash rate is 8.25%, and that doesn't look like changing anytime soon because even though our economy is slowing, we still have an inflation problem. Meanwhile, the US Federal Reserve is about to cut its rates to 2.5%, even though it also has an inflation problem. The difference is the Fed is desperate to avoid a financial markets meltdown. It's in the midst of a full-blown crisis of confidence on credit markets that threatens to radiate out into the wider economy. The upshot of that is that our currency looks so much more attractive for international investors who are feeling a little more relaxed on Tuesday morning about global markets turmoil. That's because Standard & Poor's has just said it won't downgrade the world's biggest bond insurer, MBIA, from its AAA credit rating. Now this is important because some of the world's biggest banks were worried they would have to write off tens of billions of dollars more from their loan books if the insurer for these bonds was downgraded. We said a few weeks ago the Kiwi would remain supported around 80 cents because issuance of New Zealand dollar bonds to investors remains strong. That's still the case, and you shouldn't expect a big fall anytime soon. I'm Bernard Hickey from interest.co.nz with the daily briefing. Catch you on Wednesday.